Welcome to the look at the week ahead for the week 25 to 29 July 2022. This week we have significant economic news events. We will find out this week if the US is in a technical recession when we get the GDP news release. Let's take a look at the economic news calendar. Here we have this week medium and high impact news events. Please take note of the high impact events which are in red. All times shown are Singapore Standard Time, which is 6 hours ahead of South African Standard Time. Now, please, as we always mention, the actual impact of the news release is never known in advance and will depend on many factors. The events marked in red have the potential, not the certainty, to increase market volatility. As traders, we need to monitor these events and anticipate market moves so that we can position ourselves usually after such events take place. Be mindful that high impact events, especially those involving central banks, can create above average volatility. So last week we have seen significant changes in interest rates. Let's take a look at them. So here we have a table that provides a quick snapshot of current interest rates, which have seen significant changes worldwide. Changes in interest rate policies often will bring macro changes as market participants will shift their positioning. With the exception of Japan, all countries here have raised their interest rates, with Canada being the most aggressive with a 1% hike, followed by the US with a 0.75% increase. Canada and New Zealand now offer the highest interest rate at 2.5%. What else? Most of these changes happened last Friday, so this is still early days. Last week we reported institutional buying in the New Zealand dollar currency future, which translated in a rally last Tuesday in the Kiwi dollar pair. Note how the institutional buying in this currency future came before the interest rate announcement, which only happened on Friday, 22nd July, i.e. 2 days ago. Now, as of today, we don't see additional institutional flow into the Kiwi dollar at this time. For the record, the market seems to be expecting a 75 basis point to 100 basis point increase from the FOMC this week. So this week promises to be a very interesting time for central banks and traders around the world. Let's take a look at Treasury yields where we stand. So no big changes here. We made an intermediate high in yields, and we kind of retraced back a little bit. The market is expecting risks and challenges ahead. The yield curve remains inverted. A recession, technical or otherwise, seems to be knocking at the door of the US economy, and it's knocking very loudly. The challenges on the horizons are many from a market perspective. Questionable policies in the G10 economies, runaway inflation, food scarcity, mass protests, momentum building on BRICS countries' ideas to create an alternative reserve currency mechanism to parallel the US dollar monopoly. Europeans are now being asked to shower less frequently and save on energy, while the green economies there are now using coal for energy, which is the dirtiest form of carbon fuel that you can use. All this while winter is coming for real. Many will be seeking safety in case any of these issues can affect their portfolios. So again, this week we have significant data releases, and we can expect the FOMC statement, federal funds rate announcement, to see the Fed chair fully embracing what they see as a historical challenge, opportunity, depending on your viewpoint, to embrace the late Paul Volcker's inflation slayer mantle. Paul Volcker is famous because as a Fed chair, he tamed inflation back in the late 70s, 80s, in the 80s really. And this seems to be the time for Fed to be remembered, Fed chair to be remembered as the new Paul Volckers. Let's move on to relative strength graph. No big changes here in the yields. It's kind of dropping from the high, intermediate highs we have seen. It could change this week, but let's move step by step. Here we have the relative strength on currency futures. I apologize for this rather busy graph, but this is a quick snapshot on how to look at all the above markets, all these markets. And notice that they have been rallying against the US dollar. So this represented broad dollar weakness. It could simply be a retracement. It could be something more significant, but we will find out this Thursday. Among the currencies here, our model suggests that the weaker ones are currently the Japanese yen and the British pound cable. As we have high impact news events this week, we need to be open to potential and sharp moves reversing the recent moves we have seen in the past 1 or 2 weeks. On the GDP front, we could see the announcement that the US has entered a technical recession, i.e. 2 consecutive quarters of negative GDP. Now, this may be an event on the media and television, but we need to remember that institutional money has already priced in a recession during the past few weeks. So whatever happens this Thursday, it will be cosmetic moves, volatility taking place because of low liquidity, and then after the actual release, we will see the real positioning of, hopefully, of markets, and we could take advantage of that. So that should offer some decently tradable moves. Now we are entering the summer doldrums. It's a real thing. So liquidity is lower compared to the other months of the year. So while the moves will be there, they will not be as powerful. They will not have as strong momentum as they normally do and during such releases. Let's move on to the dollar index. This is the weekly dollar index graph. Please note the blue rectangle here on top. This is the weekly resistance we have been talking about for the past few weeks. Price finds itself in the middle of that currently. So the retracement we expected has materialized. And looking at this chart, we could see the dollar index move lower, potentially to the 105.80s, to the 105.60s. If we move to the daily graph, we will have a little bit more granularity, and here we see the potential for a much lower move that could be unleashed. Again, Saturday's GDP and Thursday FOMC and GDP figures could bring such volatility that could bring the price of the dollar index lower. We see the support for the dollar index here on this chart at the institutional level of 105.20. If that support is broken, then it will be a not so slow move down to the 103.20s. Currently, that seems a little far from this chart, but it would be the unexpected move that makes it all the more plausible. It's the unexpected that usually happens in the market, and this could be the little unexpected move that could unfold. Now, on the other hand, for the dollar index uptrend to continue, the dollar would need to break above the 107.30s with speed and momentum. We do not see this currently in this chart on early Monday price action. So our expectation is for this market to consolidate until Thursday FOMC announcement. Should the dollar continue to weaken after the FOMC announcement, then we see the potential strength in the Swiss and the Canadian dollar, on the Swiss franc and the Canadian dollar, to offer a potential trade against the dollar. If, on the other hand, the dollar finds new strength, then we will be looking to match that with weakness in the Japanese yen and in the British pound. Now, please note, these are not complete trade ideas. The currencies we mentioned offer potential conditions for a successful trade, but we need to find precise and clean setups, and we should see these um, conditions remain in play after the FOMC announcement. If such clean setups are not offered by the market, then we might just be working on an intraday basis, or we just sit on the sidelines, which is also fine. Again, we are entering the summer doldrums, so it's either intraday or sidelines if we don't see clear setup reflecting the conditions we mentioned earlier. All for now. Good luck and good trading.